but I can say my welcome words because that is not the most important stuff this afternoon. But welcome to you all on behalf of CFA Society VBA Netherlands. I see a lot of familiar faces, but for people I don't know, my name is Annemarie Munnik. I'm the Executive Director of CFA VBA. And I say a warm welcome today to all the people attending, as well as our two speakers, I must say, Kristina Hooper and Anatole Kaletsky, and our moderator of today, Han de Jong. It's obviously a theme, inflation, on everyone's mind at the moment. It already was out there for a couple of months, and then the energy prices, and because of the war, hit the also inflation outlook. So we're looking forward to a lively debate on the subject. The discussion this afternoon will be moderated by Han de Jong. Probably you all know Han, who has been a chief economist at ABN AMRO for 14 years. Now he has his own research from Crystal Clear Economics. And he writes a lot of columns, economic commentary. So he's quite outspoken. So I'm really glad that you will be hosting the session today, Han. Just a bit on the logistics side, we have some interaction, so we're going to ask you your opinion a couple of times. So we're really looking forward to your own views on the inflation outlook and how your portfolios are positioned. And we hope you have lots of questions. And because we have a lot of people in the call today, we would like to ask you to ask your questions through the chat. And Han and myself will be looking out for the chat and moderating all the questions. So with this short introduction, I would like to give the floor to Han.
Okay, well, thank you very much, Annemarie, and thank you for giving me the opportunity to do this. I'm looking forward to this webinar. Hello to everybody. I think my first job is to introduce our speakers today. So we have Kristina Hooper. She is the Chief Global Market Strategist at Invesco. She's based in New York. She's been with Invesco, as far as I'm aware, for about 5 years. And previously, she worked in similar roles with Allianz Global Investors and PIMCO, UBS, and MetLife. And of course, most of you will know Invesco, a large international asset management company. They have over 8,000 employees, and they have assets under management to the value of $1.4 trillion or thereabouts. They're represented in Amsterdam. They have an office at the Zuidas, from where they provide customer support. The other speaker that we have today is Anatole Kaletsky. He is the co-founder and chief economist of Gavekal, a company that he founded together with Charles and Louis Vincent Gave in 1999. Gavekal is, most of you will be familiar with Gavekal, I guess. It's one of the world's leading independent providers of economic and financial research. I think it's fair to say that they are known for their original and thought-provoking views and analysis. And apart from doing research, they also provide services in money management and portfolio construction. And Anatole, before he co-founded and worked for Gavekal, he worked as a journalist for 30 years and a commentator, and he worked for among others for the Financial Times, The Economist, and the White Times, or the London Times. And I must say I'm especially delighted to meet him today because he wrote a book in 2010 called Capitalism 4.0, and at the time I read it, I thoroughly enjoyed it. I think I can still recommend it. I think it was nominated for the then Samuel Johnson Prize, which is the prize for the best nonfiction written in the English language. So very prestigious. And I think the key message of that book is that capitalism is a spectacularly successful system in improving the living standards of people, but it has inherent frictions and tensions, and it sometimes moves a little bit out of balance. And then when it looks as though capitalism will collapse. It actually doesn't collapse. And I think the way Anatole writes it in the book is capitalism doesn't break, but it bends, it adapts, it changes, it's flexible. One of the most impressive things in the book, I must say, is a personal thing for me and maybe for Anatole as well, I guess. It's he dedicated this book to his parents. So on one of the first pages of the book, and I would like to read that out to you, because it has since I read that, it's been an important message in my life. So he wrote that he wrote the book in memory of my late parents, Jacob and Esther Kaletsky, who experienced true calamities and crises: the Russian Revolution, the 2 world wars, the Holocaust, the purges of Stalin, but whose joyful and indomitable spirits lived on. And I have to admit, I had to look up the meaning of the word indomitable, but it's onverzettelijk. It made me realize how lucky I am that I was born when I was born and where I was born. and I guess I'm lucky, but most of you are equally lucky, and other people have experienced all sorts of challenges in their lives, and I think it's good to realize how lucky we are. Anyway, without any further ado, I'd like to start this webinar with a poll question. So Irma is going to put up the poll question. It is just an effort to measure the ex ante mood of the participants as far as today's topic is concerned. Now I can't. Irma she's making gestures. Do we have to click away the chat? Oh, just a few seconds. Can you indicate, Irma, if this is going to work or not? It is going to work, she says. Okay. I suppose if...
Here we are.
Here we are. So current high inflation is due to temporary factors, and investors need not reposition their portfolios because of it. 3 possibilities: agree, disagree, or unsure. And then you have to press submit in the bottom of the screen. I think we have a minute for it, but my screen says the time remaining is constant at 46. Oh, okay. She's giving the thumbs up.
We can see it, Han.
You can see it?
No, I cannot. Can you?
No, neither can I.
Okay.
Oh, there we are. Okay, so, all right, okay. So 36% of people disagree, so that would be the pessimistic view, so to say, and 12% take the more optimistic view that it is temporary and not too much to worry about, and a quarter of you are saying, well, we're not so sure. So I mean, that is actually an excellent result for the poll to start this webinar, because it means that at least a quarter of you are open to be convinced, and hopefully all the others as well. Now, so thank you for that. And with that, I think I'd like to hand over to Anatole, who is going to do the first presentation.
Oh, well, okay. Thank you very much. Yes, and I'm glad. I think we have more than 25% to convince, because we also have the 28 who didn't answer at all. So we have a fertile territory here to explore. So I think the plan, Han, is that I will speak for about 15-20 minutes to outline my ideas, and then Kristina, and then we'll debate it. Yes. So I'll try to be fairly brief. I'll have to be fairly brief, because there's a lot of issues that really we need to discuss in answering this question. So I'll just give you a superficial overview of the main ones, and then perhaps I will be able to get into more depth with some of the others. I have a presentation of which I'll just use the first few slides so that you can see what I'm talking about. Essentially, my view, and my view has changed really quite dramatically from about 3 months ago. 3 months ago, I would have voted in that poll, Han, with the minority who actually still see inflation as a transient phenomenon resulting from the bust boom of the COVID and a number of other temporary factors, perhaps the overheating of some of the world economy, the US economy, perhaps the UK economy, but I don't think it's possible to argue that, for example, the main European economies, Germany, France, Italy, are yet overheating, nor is the Japanese economy overheating. So until a few months ago, I would have answered in a more relaxed and confident, and from an asset allocation point of view, bullish mode. And my view was, as you know, there have been people arguing for the last year or even year and a half that actually the expansion of monetary policy that we've seen all over the world after COVID, the enormous fiscal interventions, combined with the supply dislocations, were going to lead to permanently higher inflation. And very distinguished commentators like Larry Summers, Mohamed El-Arian, and so on, have been warning of a return to a 1970s style inflation, possibly leading to stagflation, for the last year. I was dismissing those warnings until 3 months ago. And in fact, I was arguing that if anything, if we wanted to look at history, the decade ahead, to me, looked less like the 1970s, the stagflation period, and perhaps more like the 1950s, the immediate post-Second World War period, when inflation was rising, yes, but rising from very low levels and at a very moderate pace, so that at the beginning, of the period, you had average inflation, excluding the Korean War effect, running at maybe 2.5%, and by the mid-1960s, it had risen to 3.5%, and by the late 60s to 4%. But this was a very, very gradual increase in inflation over 20 years, and that was combined with much stronger economic activity than the world had really ever seen before, and what was at the time described as the Keynesian golden age, the golden age of Keynesian macroeconomic demand management policy. Until a few months ago, I thought that that was a very plausible outlook, something like that. Obviously, history changes and different countries have different balances, but that was at least a useful mental model to try to think about the next decade. And the 1970s, I thought, was the wrong model, because it was based not just on a temporary spurt of inflation, like the one that occurred in the Korean War and the Second World War itself, but on a permanent, inbuilt, and very, very intense inflationary pressure, leading to wage price spirals that became impossible to control without very, very aggressively deflationary policies from central banks in particular, and to some extent governments tightening fiscal policy in the 1970s, and that led to stagflation. So I felt that was over pessimistic. I've now changed my mind. And the reason I've changed my mind is really summarized in this slide. What has happened over the last few months is not one event, or not the culmination, if you like, of the monetary expansion that we've seen over a decade, the supply disruptions and so on, but it's been the convergence of four very, very powerful forces. And actually the last of these, the fourth force, is the one that, in my view, tips the balance from the possibility of a gradual inflation combined with stronger economic activity, which was my hope and the hope of the central bankers, the hope of, particularly in America, of people like Jerome Powell and Janet Yellen, who openly talked about wanting to run a high-pressure economy, wanting to run the economy hot in order to maintain very low levels of unemployment and affect a redistribution of income in favor of labor, away from capital and so on. What happened was that the fourth shock, the shock of the war, and the resulting very, very powerful energy inflation, and yet to come, I think, is another very powerful burst of food inflation over the next few months, has transformed what could have been a temporary and manageable increase in inflation into what I think now will be a permanent, deeply embedded and very widespread inflation, especially in the US economy, which is, of course, the economy that creates the climate for financial markets and to some extent for economic activity all over the world. Now, we may in discussion come back to these factors, but the first, well, in fact, they're all pretty obvious, but I don't really need to say anything about the decade of monetary and fiscal expansion, culminating in the last few years, unprecedented. There was a pretty widespread view in the markets 15 years ago that inflation is always and everywhere a monetary phenomenon, and therefore, if you had enormous expansion of central bank balance sheets, that alone would lead to inflation. That view turned out to be wrong. It was, if you like, tested empirically in 2010 and 11, and it turned out that actually central bank balance sheets can expand very rapidly without necessarily generating inflation. But that doesn't mean that monetary and fiscal policy is irrelevant to inflation. What it means is that monetary and fiscal expansion is a necessary condition for inflation, but it's not a sufficient condition. There's got to be other things. Now, the next thing that happened was the supply disruptions and cyclical overheating that resulting from the bust boom. That made the monetary and fiscal expansion much more dangerous. But in my view, and I think this is going to turn out, and the view of central bankers all over the world, Christine Lagarde, Jerome Powell, that overheating was still a temporary phenomenon, resulting from the, after all, totally unprecedented events of 2020-21. 2020, the biggest collapse the world economy has ever seen, bigger even than the 1930s. 2021, the biggest boom the world economy has ever seen, at least since the 1950s. So, to my mind, and that of many central bankers, it wasn't surprising that for a while you also had very big supply disruptions, high inflation, and so on and so forth. So I think at the end of last year, it was still possible to consider that to be a transitory phenomenon. On top of that, you've had, I think, over the last few years, a number of big structural changes, which are much more slow moving, which have certainly weakened and perhaps even reversed the structural disinflation that has been going on for 30 years. Again, I'm not going to go into great detail about them because everybody is aware of them now. Everybody's been talking about it. When I started talking about some of these things like deglobalization, the change in technology 4 or 5 years ago, this was still a controversial issue. But I think now it's widely understood that some, at least, of the most powerful disinflationary forces that really began in the 1990s have now been neutralized and possibly even gone into reverse. And of course, the geopolitical situation has exacerbated that. But even being aware of that, I wasn't too worried about inflation 3 months ago because I thought these are very, very slow-moving developments. These are the sort of things that will lead to higher inflation over the next 10 or 15 years, but not dramatically higher. These are the sort of events that could lead to a 50s and early 60s type of scenario rather than a 70s and late 60s. But then 2 months ago, we had the fourth of these forces, the perfect storm, the energy and food shock that has translated what could have been a temporary inflation, likely to end actually in the second or third quarter of this year, into an inflationary period that will persist at least until the end of this year and quite likely well into 2023. As a result of that, I think inflationary expectations and inflationary behavior are only now starting to break out from the supply constrained manufacturing and commodity sectors into the broader economy, into the service sectors. Inflation is becoming very broad based. You can see that particularly in the US data, which gives the most sort of granular analysis of different inflation sectors and so on. And we might come back. I have some charts illustrating that. We might come back to that in the discussion. So the inflation is spreading. If that spread if that inflation were to be reversed in the next few months, I think you could argue, well, that spread will stop and gradually inflation will narrow back to the kind of low productivity service sectors, which is what have been driving 1-2% inflation over the last 10 years. But if inflation doesn't come back, then it starts to get back. It is starting to get included in corporate business models, in pricing power across the economy, and very importantly, in wage formation, in income formation, both from the demand side in the sense that workers try to get higher wages, but also in a sense, in the supply side, the workers, won't work unless they get wages that at least maintain their living standards, but also from the demand side, especially in very low inflation economies like the US and the UK, where employers realize that they have to pay higher wages, and they also believe that they can get away with paying higher wages because they have unprecedented pricing power. They have pricing power of a kind they haven't enjoyed literally for 40 or 50 years. So they can raise wages to recruit more labor because they know they'll be able to raise prices to protect their profit margins. So I think the key change that has really happened in the last few months is that what was still arguably a temporary transitory phenomenon, and there was this whole debate about team transitory, and people laughed at the Fed for saying that you're removing the word transitory. But I believe that there was at least a decent chance, and I'll come back to this, and this will be my last point, then I'll stop. There was at least a decent chance until the war broke out that actually team transitory would win in the end, and the inflation would turn out to be transitory, not for 3 or 4 months as they hoped, but for, let's say, 6 or 7 months, but that would come down. Now I think that hope has been dashed by the war and the sanctions. And this, I think, is what leads the current situation to be much more like the early 1970s, when you had a rise in inflation gradually over a decade or 2 decades. In early 1973, US inflation was running at about 3.5%. Inflationary expectations were still at about 3.5-4% level. Then on October, you had a quadrupling of fuel prices caused by the Arab oil embargo, and suddenly inflationary behavior, inflationary expectations took off, and within a year, it was at 10%, and it really ultimately took a decade and interest rates of 20% to reverse. So why do I think this war is so important? And also, why do so many people in the markets still, I think, not believe this permanent, are still very skeptical about this permanent inflation story? And in fact, in some ways, at least until the last few days, I've found that the psychology in the markets has become actually more confident about inflation and to some extent about risk-taking than it was 3 months ago. 3 months ago, everybody was panicking about inflation's going up and up and up. Last week, when the US reported 8.5% headline inflation, the highest rate since the early 1980s, the reaction within 24 hours was to say, well, this is bad news, but the good news is this is the peak, and it's soon going to come down. It's not going to go any higher. I think that's right. It's not going to go any higher, or maybe it will go higher for another month. But the point is, will come down from 8.5% to 7% or 6.5%. I see no prospect at all that it's going to come down to the 2 to 3% range, or even 2 to 3.5% range, that would be acceptable and manageable for the central banks, and acceptable to European and American societies. So why do I think this change has been so abrupt? The reason is, and it's illustrated really in this chart here. The reason I believed until recently that Team Transitory might win, and now I think they have no chance, is that so much of the really alarming headline inflation of the last few months has been due to two factors. One, the energy price jump that already occurred last summer when oil prices went from $20 a barrel to $80 a barrel. And two, the base effects, which were really a payback for the very low or even negative inflation during the COVID slump. During the COVID period, pricing power collapsed, many prices went negative, especially for services like airlines and so on and so forth. And therefore, it was not surprising that a year later, inflation suddenly jumped up because you were paying back. It was a payback effect for that. And the energy prices, as I said, already had a big energy shock last summer. So if you look, for example, at the US headline rate of inflation, the last monthly figure is 8.5%. You take out food and energy, it's 6.5%. So already 200 basis points of that is the food and energy. But if you then average over 2 years, rather than just looking at the last 12 months, look at the 24 months, in other words, including the bust as well as the boom, well, in the US, ex-energy, 2-year inflation, even today, is still only running at 3.5%. So you could argue that 2/3 of that 8.5%, 500 basis points of that American inflation, is potentially a reversible effect from energy and food, and a temporary and definitely reversible effect from the base effects. In Europe, that difference is even more spectacular. The underlying inflation in Europe, excluding food and energy, averaged over the last over 2 years, is still 1.9%. It's still below the ECB's official 2% target. So in Europe, almost all the excess inflation is due to these energy effects and the base effects. Until the war broke out, if you looked at the month-to-month development of inflation, particularly in the US, but also similar arguments apply to Europe, it was almost, I described it wrongly as almost a mathematical certainty that inflation would come down dramatically, literally from April, from this month onwards, simply because of this base effect. Because in the second quarter of 2021, you had this enormous upsurge of inflation due to the COVID reopening and the payback for the COVID disinflation. As those monthly, very, very high inflation figures drop out of the annual comparison, it seemed almost guaranteed that headline inflation would fall by 200 or 300 basis points during the second quarter, both in America, especially in America, but also in Europe. That hope is now dashed because we now have a new base effect caused by something completely different, which is the war in Ukraine and particularly the sanctions against Russia. The second thing that, of course, has even more been dashed is the hope that energy inflation would zero out essentially from this summer, because if energy prices had simply remained at the very high levels they reached last summer of $80, $90 a barrel, if they'd remained at that level of July and August, then energy inflation would also fall to zero by July and August this year. That, again, I think is very, very unlikely, given the sanctions against Russia. And incidentally, it's the sanctions that are much more important from this point of view than the outcome of the war. So once you remove those two factors, the energy stabilization, which is not going to happen, and the reversal of base effects, that's not going to happen, I think it's now almost certain, again, I would say it's almost a mathematical certainty, that very high rates of inflation will persist into the third quarter and probably into the fourth quarter of this year. Doesn't mean it's going to be 8.5%, but let's say rates of 6%, 5 or 6% plus in the US, 4% plus in Europe seem essentially baked in the cake. So why are the markets, actually so many of the markets, and I would say the market pricing is still relatively optimistic about inflation coming down. And I think there are two reasons. One, which is summarized in this slide, and I won't go into in detail, is this idea that geopolitics always misleads financial markets, and you should always ignore geopolitics in asset allocation and in economic forecasting, because it leads to temporary panics, but these are always reversed. You should fade geopolitics. That's broadly speaking been true. If you look at this chart, this shows all the geopolitical disruptions over the last 100 years, and most of them have provided buying opportunities for risk assets. But there's been one spectacular exception, and that was the period from 1973 until the early 1980s. And the reason I think that that was such an exception is because the geopolitical impact, the geopolitical impact on inflation came on top of a period of over a decade when the inflationary pressures were gradually building up. The necessary conditions for inflation had been put in place through monetary policy, fiscal expansion, the Vietnam War. But to turn those into sufficient conditions took the Arab oil shock. But once that shock took place, and once the inflationary expectations were embedded, it became very, very difficult to reverse them. And this brings me to my second and final point. The other reason why I find that people are still surprisingly calm and relaxed about inflation is, well, now the central banks have realized their mistake. They made a policy mistake last year, and now they're going to tighten. They're going to tighten much more aggressively than we expected. Well, it's certainly true they're going to tighten much more than we expected, or they expected even a few months ago. But if you think about the degree of monetary tightening that is priced in, and that I would argue is even politically and financially possible over the next 12 months, it is not remotely enough to reverse an inflation rate of even 5%, never mind 7 or 8 or 8.5%. The markets are now pricing in Fed funds at 2, maybe 2.2% at the end of this year, a terminal rate of 2.8 or 3% at the end of 2023. In Europe, it's even less. You know, the market's pricing in, yes, the Fed is yes, the ECB is going to move from negative to positive interest rates. But when you compare that with the rates of inflation that are already built into the system, we're still looking at deeply negative interest rates. And both economic theory, I would argue, and especially economic history experience illustrated by this, and this is my last chart, suggests that you don't reduce a very, very high rate of inflation by maintaining still negative real interest rates. If you want to force inflation down and keep it down, you have to do what Paul Volcker did in 1980, 1981, and get interest rates up to levels which are very, very high, not just in nominal terms, but also in real terms. 5, 6, 7% real. In those days, it was up to 20% nominal. Now, I'm not saying you need 20% nominal now, or even 5% real, but surely you need something more than 0% real, even to exert any downward pressure on inflation. That is going to happen eventually, which is, I think, why we will have a recession eventually in the US and in Europe. But it's not going to happen this year. Even in the US, even the most aggressive members of the Federal Reserve Open Market Committee are not thinking in terms of moving to positive real interest rates within the next 12 months. And let's not forget that monetary policy always operates with a lag. This is another kind of bizarre idea I keep hearing from people in the markets. They say, oh, well, the Fed's on the case now. The Fed's starting to tighten, and therefore inflation is going to start coming down in the next few months. Why? Even if the Fed were to move in Volcker style to an aggressive monetary policy of very high real interest rates, it would take a year for that to have its full, a major impact on real economic activity, causing higher employment and a downturn, a recession, and probably a year and a half to 2 years before it had the anti-inflationary effects that currently expected, which is why I believe we are now moving into a much higher inflation and a permanently higher inflation environment, which is going to last at least for the next 2 or 3 years until the next severe recession, which I don't think is going to happen for a year or two. And that requires a completely different asset allocation from the one that worked not just for the last 10 years, but the last 30 or 40 years and that's a subject to which we may return in the discussion. But I think I've probably overstayed my welcome already, so I'll stop now.
Well, thank you very much, Anatole. That was very interesting and thought-provoking, as I mentioned that you guys specialize in. Okay, we're going to Kristina now in a second, but I have two questions for you, and they're just yes or no questions.
Okay.
And I think I know the answer, and I'm going to ask Kristina exactly the same questions immediately, just to break up the two presentations for a little bit. It's actually a statement. So you agree with this or you disagree. So my first statement is central banks must give priority in the short term to bringing inflation down over trying to avoid a recession. Would you agree with that or disagree with that, Anatole?
I don't know about must. If you ask me, sorry, this is not a one-word answer. If you ask me, will they give my priority to it? I would give a very clear no. I don't think they will give priority. I don't think they will move a great. Should they? That's a sort of moral judgment. Actually, I think they probably shouldn't. I think they probably should allow this process to play out over several years. But in any case, I don't think they will.
Okay. And the second statement is investors who want to protect their portfolios against inflation are already too late.
No, I don't think they are too late. Again, I think they should be protecting no, I don't think it is too late, and perhaps we'll come back to that. I think a lot of assets that still have upside in this inflation environment. Okay,
then we move to Kristina, and maybe I can ask her the same questions and see what she thinks. So Kristina, the first statement is, and I read it out again, central banks must give priority in the short term to bringing inflation down over trying to avoid a recession. Would you agree with that or would you disagree?
It depends. I think that each economy is different. And so a lot of each central bank's decisions will be based on just how significant the risk of recession is and how deep a recession could be. I think the ECB has to tread a lot more carefully than, say, the Bank of Canada in this regard, just because the recession risks are that much higher. So I think it's going to be a delicate balancing act. And it really is going to be, it's not a one size fits all kind of situation. It really has to depend upon the circumstances of each economy. And I think the ECB has to be much more concerned about the potential for a significant recession.
Okay, thank you. And so the second one is investors who want to protect their portfolios against inflation are already too late.
Well, not necessarily. We've argued for a long time that investors should have an approach that includes, for example, alternatives. That a rough portfolio allocation could be something along the lines of 50% equities, 30% fixed income, 20% alternatives. There are some alternatives that are certainly have historically been adequate inflation hedges, like commodities. So many investors likely do have some inflation hedging already in their portfolios. And we know that equities can be a good inflation hedge at times, so long as we don't see central banks sending economies into recession. Of course, as Anatole pointed out, that would require a different asset allocation for the shorter term, just given a very different change in the economic cycle.
Okay, well, thank you very much. We'll now move on to your presentation, but not before I have called on the participants to pose questions in the chat. I'm watching the chat, but I don't see any questions yet, and I'm sure you have many. So we'd be delighted to see your questions in the chat, and then Anna-Marie and myself will pick them up and post them in the Q&A session. So the chat function, you have to press a button there on the bottom right, at least on my screen, and then the chat column turns up, and there you, okay. Okay. I have a few privately privately sent messages, but please ask general questions as well. So, Kristina, please go ahead.
Sure. First of all, I want to say what a privilege and a pleasure it is to be with you all. So thank you so much for having me. It's great to be sharing this time with you, Han, as well as Anatole. So Anatole made some excellent points, and I agree that the case for transitory inflation has decreased with Russia's invasion of Ukraine and, of course, the subsequent sanctions that have occurred. But I don't believe that it is an open and shut case that we're going to see very high persistent inflation for a long time. But let's review, first of all, where we were before Russia's invasion of Ukraine. We had actually seen supply chain pressures come down for the Eurozone and the UK. So there was certainly improvement there. We saw a peaking of freight costs. I'll get into that in a minute. Prices of polyethylene found in packaging had declined meaningfully. Semiconductor prices had eased. Truckers were returning to the workforce in a number of countries, including the United States. So this was an environment in which we were already starting to see that inflation was somewhat transitory. I'm always careful with that word because it is not necessarily as temporary as some might think, but it was still in the larger scheme of things, not permanent, far from permanent, and that is one of the textbook definitions of transitory. Now, we certainly saw some very significant market-based inflation expectation gyrations. Right? This was not a situation where there was a steady, there was a very steady view of where inflation was going. We saw commodity price shocks due to Russia's invasion of Ukraine cause a surge in inflation expectations. We've seen them come down because of the spread of COVID and COVID lockdowns in China. So this is a very, to me, reactionary measure. I think it's one that central banks care less about than consumer-based inflation expectations. The reality is that consumers have an enormous amount of control over where inflation goes. Because it's largely about consumer psychology. So while we can certainly look to market-based inflation expectations, I don't think that tells the real story, and it's certainly not what I would anticipate central banks are most focused on. Now, I certainly expect volatility to remain high with inflation expectations, but again, I think market-based inflation expectations are going to go through gyrations. What's more important to look at are those consumer-based inflation expectations, which we can find in a few different surveys. I pulled out ones in the US, but I don't think they're that different than other major developed economies. So if we look at this is the New York Fed survey of consumer inflation expectations, and it looks at the 1 year ahead, which is the dark blue line, as well as the light blue line, which is the 3 year ahead. One can make the argument that even though the 3 year ahead is elevated, right, we're well above the 3% level, it actually hasn't gone up in reaction to Russia's invasion of Ukraine. So again, I want to be careful with the words I use, but we can make the argument that they are certainly not unanchored, and to a certain extent are relatively well anchored. Again, I want to be careful with that because I know that it's elevated. But when you think about just the kind of inflation headlines we've seen, when you think about how much has changed in the last few months, it is striking that we haven't seen a big bump up in 3 year ahead inflation expectations. Yes, we have for the 1 year, but I would expect that. And that speaks to the more transitory nature of much of the inflationary environment. Not necessarily all, which I'll get into in a minute, but much of. And it's not just the New York Fed, although I think the Fed looks at that the most, but the University of Michigan also does a survey of consumers. They look at the 1 year ahead as well as the 5 year ahead. And look at how constant the 5 year ahead is. Again, it's elevated, but we just haven't seen a big increase from Russia's invasion of Ukraine. Now, agreed that Europe is far more sensitive to this issue, and that we're going to see that reflected. But in general, what I would say is that there is some anchoring of inflation expectations, and my argument would be that we're likely to see this continue. Not because I agree completely with Anatole. We have a really significant time lag between when monetary policy is implemented and when it has some impact on the economy. But I would argue it's not so much about the implementation of monetary policy, it's about rhetoric. It is about the hawkish rhetoric coming from the Fed, which may not actually culminate in very significant rate hikes this year, depending upon what happens. But we've already seen a very significant tightening of financial conditions. For example, in the United States, we've seen the average mortgage in just a few months go up from about 3% for a 30-year fixed mortgage to a little over 5%. So we're already seeing a self-fulfilling prophecy when it comes to tightening of financial conditions. But more importantly, I think it is that Fed's rhetoric. I think we need to draw a distinction between hawkish rhetoric and hawkish actions. Actions can take a long time to actually make their way into the economy, but it's the rhetoric that can impact investor psychology. Now, let's be honest. The fiction is that monetary policy can cure all inflationary pressures. But we know that central banks aren't going to get Russia to leave Ukraine. And they're not going to get countries to roll back sanctions. They're not even going to get workers to return to the workforce that are fearful about COVID. Other factors are going to do that. But what we do know is that anticipation of central bank action can impact investor psychology, and I don't want to overlook that point. Now, just another sign of investor psychology and where we are, and the differences I would draw between this time and the 1970s can be found in views, again, from consumers about whether or not this is a good time to purchase major goods. And so the University of Michigan, of course, does a number of different questions in its consumer survey. And some of the most interesting are around, what are the buying conditions like? Are these good buying conditions or bad buying conditions? The reason that this can be helpful is because bad buying conditions suggest that consumers will wait for any purchases they don't need to make immediately. So I understand if your car breaks down and you do not have a car and you need a car, you're going to go out and buy one. But there's a large portion of consumers that don't need to buy a car today or even tomorrow. And for them, it's helpful to know that they think this is a bad time to buy a car. They don't think that prices are going to be going up a year from now. Rather, the assumption is that prices could be lower a year from now, so we'll wait. And so that helps to curtail that self-fulfilling prophecy of expecting prices to go up, and so buying now to help drive prices up. That was something that was very much a part of the 1970s that we have not yet seen today. Now, admittedly, that can change, but I think it's less likely to change when we're getting hawkish rhetoric from some major central banks and when we see inflation expectations for the 3 and 5 year period relatively well anchored. So just a few other things to have some perspective on that I think might also help. If we actually look at historical prices, we can see that we're not actually anywhere near the highs that we've seen over the last 22 years for a number of commodities, with the exception of aluminum, where we are very near the high. And I think that's certainly specific to Russia's invasion of Ukraine. But this speaks to an environment, again, for those consumers who've been around long enough. There is some sense that we aren't at the highs for a number of key commodities. And in fact, even in the course of the pandemic, we've seen prices rise and fall. Timber prices have gone up, they've come down, they've gone up. And I think that also helps in terms of shaping consumer psychology around where inflation is going and just how permanent it is. Now, again, there could be changes going forward. I just think it's less likely because central bank hawkish rhetoric can shape consumer psychology. And I don't think we want to underestimate that power. So, you know, I will also just mention in one key area that I think is helping is oil. You know, as soon as Russia invaded Ukraine, there were forecasts about $150 a barrel oil, $200 a barrel oil, and that has not yet come to fruition. Now, if we see more sanctions imposed, that certainly could. But as of now, I think that certainly has helped shape consumer psychology. And actually, if we look at the history of oil prices, what we find is that, you know, adjusted over time, on only about 8% of the months since the 1870s have we seen oil prices above $100 a barrel. So that suggests that you know, certainly we can have an increase in prices over the shorter term, but that supply and demand imbalances have a way of working themselves out, even with major needed commodities like energy. Now, again, the 1970s was an anomaly, but it was an anomaly for a number of different reasons. We're certainly less reliant on energy today than we were then. There weren't as many alternatives back then as there are now. And so in many ways, I would argue that we're more reliant on semiconductors today, perhaps, than actual oil. But I also think it's important to recognize that the environment can shape consumer psychology. And so to go back to the 1970s, I know the big fear is that we enter another stagflationary environment. The 1970s was quite different in that we had high unemployment at the same time that we had high inflation. And so I look at a little index commonly known as the misery index, which is essentially just the inflation rate plus the unemployment rate. And what that shows us is that when you look at those, conditions in the 70s were quite miserable. And you could argue that was stagflation. But we're a long way away from that today. And I think that should also be shaping consumer psychology. So just a few other points. I talked about semiconductors, and semiconductor prices have gone up a lot. But over time, Moore's law has held. So it's certainly not in place right now. But over time, it has held. So I think that also helps shape consumer psychology in terms of having that back history of prices coming down and an expectation that, yes, we might be experiencing some significant headwinds right now that are impacting the semiconductor industry, but that's unlikely to persist for the long term. One area that I'm encouraged by, although I recognize some of this is a result of the COVID lockdowns in China, is container prices. Now, I'll talk to industry contacts to get a sense of the inflationary pressures they're experiencing. And one of my contacts who is a department store buyer talked about just how difficult pricing had become because of the big increase in container prices. The US-China route went from about $4,000 a container before the start of the pandemic to about $24,000 a container. So we're looking here at global, the global freight index, but of course different routes have different prices for these containers. And that was just such a dramatic increase. So if you think about it, if you can fit about 20 living room sets in a container, you've gone from paying a few $100s in transportation costs to something about, I think, $1,200, $1,400 in transportation costs. That has come down. We're now looking at it in the $15,000 to $17,000 range, and that will have an impact on the pricing of goods, all kinds of goods, but of course the bigger ticket items significantly. So that's a positive sign. I don't know how long this is going to last, but again, it should help shape consumer psychology. But the really difficult area is wage growth. That to me is the sticky part of inflation. And we do have to be concerned about it. I could see a scenario where components of inflation come down, but that wages remain elevated. But I do want to make a few key points about this. First of all, if we look at where the wage pressure is greatest, it is in the service industry and lower paying jobs in general, which tend to also be the higher turnover jobs. So in countries like the United States, where we do see a very significant amount of turnover in retail, fast food, hospitality in general, you can see some resetting of wages. I'm not saying that they will go down to pre-pandemic levels, but there could be some resetting of wages in the next year or so. Especially as more workers return to work, and that's the trend that we are seeing. As COVID subsides into the background, there clearly, and of course, as a lot of benefit programs run off, there is a push to return to work, and so that will exert at least a little downward pressure on wages. But beyond that, what we know is that technology, unfortunately, is coming for a lot of the lower wage service and retail jobs. We're seeing banks retooling in order to automate more, to reduce their bank teller workforce. We're looking at major fast food companies doing the same. They're automating more, so there's less reliance on workers. And that also should, over the medium to longer term, exert downward pressure on wages. And in general, technology has that incredible power to exert downward pressure on prices, as does globalization. Now, some have argued that globalization is over, that we are entering a period of deglobalization. I think when we look back in time, we might be seeing a hiccup for globalization, but that march towards progress continues, and that again should exert a bit of downward pressure on prices. And again, while that might not have an impact, dramatic impact in the next year, I agree with Anatole completely that we are not going to see inflation get much below, in my opinion, 5% this year for the U.S. We're not going to see it get below 4% for the Eurozone. That's okay as long as consumers anticipate that it continues to come down, and I think it will. And certainly there are a number of factors that would make the case for that over the medium and longer term. So all in all, elevated inflation, but it will moderate. And I do believe that there are some countries that may be able to orchestrate a soft landing. Certainly recession risks are higher in some rather than others. And many do have some inflation hedges in their portfolios by virtue of the fact that they have equities and commodities. Whether or not that allocation makes sense in the next year will be dictated by central banks and whether or not certain economies do go into recession. That, of course, again would change, I think, asset allocation preferences over the shorter term. So I don't disagree with a lot of Anatole said, but I think we need to give a much, much greater weight to consumer psychology in all of this.
Okay, Kristina, thank you very much. Let me just to take these things together, to put your presentations together, or your two positions. My understanding is that Anatole is fairly pessimistic about investment returns in real terms over the next, I don't know, maybe years. Would you agree with that, or would you take a more optimistic view on investment returns of a diversified portfolio in real terms over the next couple of years?
So I would anticipate muted returns relative to where we've been for risk assets. I think that the spread between risk assets and, say, fixed income comes down in the slowdown phase of the economic cycle. Depending upon how long a recession might be for a specific economy, we're of course going to see areas like fixed income. We're likely to see some level of outperformance, but disappointment in general. But again, there are going to be economies that are likely to navigate this and essentially experience a mid-cycle slowdown as opposed to entering a recession. And so I think we can see solid returns in this environment. And at the end of the day, I think it's important to recognize that humans are very, very bad, unfortunately, at market timing. And so having an allocation for the long term might be a better approach than trying to time when perhaps a recession might occur and shifting one's allocation. I think a very well diversified portfolio, both within and across the three major asset classes, for the long term is still going to serve clients well in this environment.
Okay, thank you very much. Maybe I can move then to Anatole. Anatole, what would be your response to Kristina's points? So, one of her key points is that inflation expectations, as they're measured currently in the various measures, are still pretty modest. And she is saying, that perhaps we should put much more emphasis on consumer psychology. What would your reaction be to that?
Well, my reaction in general is that what Kristina is describing, I think very accurately, is the current situation. And as she said, a number of those factors haven't changed significantly in the last 3 months, in response to these geopolitical events. I think there's a very high probability that several of the indicators, particularly the psychological indicators that Kristina pointed to, will actually change and will move in the wrong direction in the next couple of quarters. One of the main reasons, to be more specific on the consumer inflation expectations, and actually I think even the market inflation expectations, which have gone up more than the consumer ones, but are still actually fairly moderate. 10-year inflation expectations have gone up, depending on how you measure them, by about 50 to 80 basis points. So there's not a dramatic reversal, and actually they also haven't moved that much in the last few months. They were creeping up from 6 months ago, and as I said in my presentation, in a sense, the psychological climax of the inflation panic in the financial markets, I think, actually was in January and early February. That's when people were really worried. And now, when I talk to people in financial markets, on the whole, they adopt a position a bit closer to Kristina's. Yeah, it's bad, but it will probably improve. Now, the reason I think that it will, I think, is more likely to get worse than get better is twofold. First of all, expectations about anything, but I think particularly about inflation, something that has been so static for so many years, are very, very strongly influenced by experience. But they're not based, where I would disagree, is I don't think they're based on an assessment of Fed rhetoric or, whether they're going to move by 25 or 50 or 75 basis points, especially at the consumer level. I don't think that has much impact. What does have impact is a whole generation of experience of, basically anybody younger than 50 has never experienced above 3% inflation. In the US and actually in Europe, they've never experienced above 1.5 or 2% inflation. So it's very natural to think that things are not going to change very much. And if there is a change in the immediate past, it's more likely to be a blip than a change in trend. And of course, it may be, most of the time, abrupt changes in life, especially in financial markets, are blips, but occasionally you get a change of trend. And when a change of trend occurs, I think it's almost the law of nature, is that it is never recognized ahead of time. It's never anticipated ahead of time. And usually it's not recognized as a genuine change of trend until long after the event, a year, 18 months, and so on. So I think, and this is why I've changed my mind, because I felt that if inflation was high for 6 months, 7 months, 8 months, it probably would be seen as a blip. It wouldn't change behavior. It wouldn't change expectations. If these very high rates of inflation continue until the end of this year, then we're looking at nearly 2 years of very high inflation by the standards of the last few decades. Anything above 4% is very high rates of inflation. If that persists for a year and a half or 2 years, I think there is a pretty high probability that it does begin to change pricing behavior, corporate strategies, wage formation. But of course, I could be wrong. But, my final point is, look, I think everything Kristina said is perfectly well-founded in facts. It's perfectly logical. And there are reasons to hope that she will be right. But of course, the cliche about bear markets is they slide down a slope of hope. For the last 12 years, until 2 months ago, I was constantly using the opposite example. I was saying, there are lots of risks out there and everybody's afraid of risks and worries, but actually it's characteristic of bull markets that they climb a wall of worry. And I fear that too many of the arguments that Kristina has presented have been on the style, well, there's a good chance that this will happen, and let's hope it happens. I hope it happens as well, but I think that's maybe, hope is a dangerous strategy.
Okay, well, that triggers a question, and I think it's a question that I'm going to ask you, which was inspired by a question in the chat from Philip. Let's say, Anatole, you said that you have changed your mind since 3 months ago.
Mm-hmm.
Let's fast forward 3 months, or if you like 6 months,
mm-hmm.
and you have reversed your change of mind. So you've gone back to your original, more hopeful view. What would trigger you to do that? So what would have happened in the meantime between now and 6 months from now for you to change your mind again? And Kristina, maybe you can answer that as well.
That's a great question. I can answer it more succinctly, because I think actually Kristina gave an excellent answer to that towards the end of her presentation. I think the main thing that could change is that if energy prices and food prices don't break out on the upside in the way that people were expecting, and I was expecting, if oil prices, they're down again today, if oil prices stabilize even at $100 a barrel, and the food inflation turns out to peak or plateau, then I think the hopeful scenario that Kristina sketched out could well be right, and I'd be very willing and enthusiastic about recognizing that.
Okay, Kristina, what would make you change your mind?
If the longer term consumer inflation expectations become unanchored. So we see a big increase in where consumers think inflation's going in the 3-year ahead and 5-year ahead periods. That's going to be very, very hard to put that to get those horses back in the barn once they're out.
Okay, well, thank you. Another question I'd like to pose to both of you is, so most central banks have either started tightening or are talking about it, and they're promising further tightening monetary policy. The question is, how much do they need to do? And Anatole has given his opinion that you know, with real rates as low as they are, and only going marginally higher, is not going to happen. But it raises the question, I think, of how sensitive is the current economy to interest rates? Surely, and I know this is a leading question and wouldn't be allowed in a court of law in the US, at least as far as we are aware of all these criminal and lawyery series that we get in television. But surely the interest rate sensitivity of the economy is now very different from the Volcker era. So arguably you need less of an interest rate increase.
Yeah.
Can we not already see the first impact of higher mortgage rates starting to come through in the housing markets in various countries? Maybe Kristina, you can be the first one to answer this one.
So I think you hit the nail on the head. I don't think we need I mean, I recognize there's a lot of brilliant people who believe in that school of thought about how you need to have rates rise above inflation to break the back of inflation. But I do believe that, again, because a lot of this is psychology, that it's all about the Fed getting to neutral and moving to a slightly more restrictive stance, or at least suggesting that it's going to do that. It may seem a lot like smoke and mirrors, but I do believe that when it comes to inflation, so much of this is psychology. And so, simply that expectation of getting a little bit above neutral, getting slightly into restrictive territory is likely to do enough to manage inflation expectations.
Anatole?
I think it's a very good question, and about the interest sensitivity of the economy. It's a very valid question, and it's my guess is that on balance, economies are more interest sensitive, somewhat more interest sensitive now than they were even 30 years ago, and certainly 50 years ago, but because of the high levels of debt, basically, high levels of debt, having said that, I think this is not a completely unambiguous answer. First of all, the consumer, the household sectors of certainly the US and most European economies actually have dramatically reduced their levels of debt, and the net asset position of households is actually pretty high. So there isn't the kind of financial pressure on households or in fact on corporates that there was, for example, in 2007-8 from monetary tightening. The other thing is that a lot of the sensitivity is to long-term interest rates rather than short-term interest rates. And while they've risen, they haven't risen all that much. Now, the mortgage rate was mentioned, and the US mortgage rate, the 30-year mortgage rate, has certainly gone up a lot. But it's gone up from exceptionally low levels. So I was just looking at a chart. The first time, at least since the 1950s, because I don't have data going back there, the first time that the US 30-year mortgage ever got below 5%, which is what it's at now, was actually 2010. So all that's happened is that, it was way above this. During the housing boom of 2005, 6, 7, mortgage rates in the US was way above this, and that didn't stop, what with hindsight was an insanely speculative housing boom. So I think it's the jury is out on the question of whether, and in Europe, incidentally, for example, mortgage borrowing has become much longer duration. So, 10, 15 years ago, nearly all the borrowing in Europe was short terms, 3 months, 6 months, and so on. Now, I don't know what the average duration is. It differs in every country, but in Britain, most mortgages are 5 years fixed or plus. So I'm not sure whether actually the world has become much more sensitive to interest rates or not. And the one point on which I would disagree is that I really don't think that the world outside the financial markets is very sensitive at all to the rhetoric coming from central banks. I'm not sure, I haven't seen any evidence of that one way or the other, but my instinct is that most people outside our little community don't really pay that much attention to certainly to what central banks are saying as opposed to what they actually do.
Okay. A more practical question is coming from Kim Thin. How about investing in emerging markets in equities? Is that still going to be attractive, or are we going to have, in a sense, sort of the perfect storm for these markets with higher food prices leading to social problems, higher interest rates, presumably stronger dollar? All these ingredients seem to be classic negative for emerging market equities. What are Invesco advising their clients at the moment in terms of emerging market equities, Kristina?
Well, I think there are certainly opportunities in emerging markets equities, but you want to be very, very selective in this environment because, of course, there are going to be emerging markets countries that are hit very, very hard by in particular, the food price shocks that we're experiencing. But there are those emerging markets countries that are exporters of a lot of commodities, that especially oil, and could benefit from this kind of pricing environment. And you also have some EM countries, primarily in Asia, that have a higher income levels, larger middle class, that's going to be less sensitive to the food price shocks. So it's certainly an environment where you want to be extremely selective, but there are opportunities in emerging markets equities. I should note, the IMF just came out with its updated forecast for growth, and they revised them down from January, not surprisingly. But now this revision downward shows 3.8% GDP growth for EM in 2022, but the expectation that goes up to 4.4% in 2023. So the growth trajectory has improved for 2023 for EM countries. So I don't think we want to write them off, but we have to recognize the risks there.
Okay, Anatole, any thoughts?
Yeah, I agree. I agree with that. Actually, everything Kristina said. There is a trade-off between potential political instability and also monetary problems caused by food inflation. So you have to be aware of that. So a country like India, I think, is now, which looked like one of the most stable emerging markets, looks to me like one of the least stable emerging markets, because it's not a commodity producer, it's a big commodity importer, it's very sensitive to food prices, and the monetary policy there is not very well anchored and doesn't have a great history. So on the other hand, there are commodity producers, and if you can identify commodity producers, or more importantly, commodity production companies that will benefit from higher pricing power and won't suffer too much from political instability, I think that there are opportunities there. The only thing I'd add, and really this is just expanding on Kristina's point, I still think, and this is where I agree, the world is still in a pretty strong growth environment, even with the downward adjustments. I think Europe may be an exception to that, and the Eurozone. But broadly speaking, the world is still growing very, very strongly, which is why I don't think inflation is going to come down of its own accord. But emerging markets have tended to be seen as a warrant on world growth. So in that sense, I think emerging market equities, at least if they're carefully selected, are an asset class that could benefit in relative terms from this change in economic environment. For example, in comparison with speculative technology stocks.
Okay, thank you. One of the first questions that appeared on the chat was from my former colleague Christopher Zeil, and he's asking what areas have not yet fully priced in a bad scenario. Can you be specific, or is that too difficult?
Yeah. Well, if I could take, so on the one hand, I don't think that long duration government bonds have priced in a bad scenario. So, there is still potentially a lot of downside in bond markets all over the world. On the other hand, I mean, unless I turn on my scenario, obviously, if I turn out to be wrong, then people will make money buying bonds at 3%. But if I'm right, there's still a lot of downside in bonds. Where I think there's still quite a lot of upside is, inflation hedges that actually work. I think, as Kristina showed, I think very persuasively in her presentation, most commodities are actually still not even near their decade or 15-year highs. Yes, they've gone up a lot, but they've gone up from extremely low levels. Let's not forget about the total collapse that occurred in this pricing. Your oil was selling at negative prices only 18 months ago. So just because a lot of these commodities have doubled or tripled or quadrupled doesn't mean that they haven't got. So I think some commodities, and obviously we've got to be selective, have upside. As a result of that, I think commodity producers have more upside because equity investors have been very, very badly burned by them. They're very disillusioned. So I think there's still a very negative mentality towards, obviously, oil stocks, but also, large scale commodity production stocks. There's all the ESG constraints and so on. So I think those assets. Now, the other one at the other end of the scale that just astonishes me by how much value there must be there in this new environment is alternative energy. Now, alternative energy stocks, clean energy assets have fallen by anything between 60 and 80% since their peak, which was in April, May of last year. In the first phase of that, it looked like just the bursting of a bubble. And obviously, some of these companies will fail, will be worthless, and so on and so forth. But of course, the same is true of so many of the space. And I think there have been two types of speculative bubbles that emerged in 2019, 2020. One was the ones that sort of extrapolated the past, the social media, the kind of the technology enabled services, many of which are still unprofitable. But a company like Uber has a market cap of $60 billion. Airbnb has a market cap of $80 billion, even though they're still losing money and have no immediate prospects of profitability. Meanwhile, so that I think is a very dangerous speculative bubble. Then you had a speculative bubble in hydrogen stocks, solar stocks, wind, anything to do with alternative energy. There was a lot of excitement, and that excitement collapsed. But these companies a lot of them will go bust, but they're valued at $2 billion, $3 billion, $4 billion. So and of course the global pricing environment and policy environment has shifted in favor of that sector to an extent that nobody could have dreamt of, I think, 6 months ago. So I'm just astonished at how much value I think, in a diversified sense, there must be now in alternative energy.
Okay, and another question comes from Brian. What kind of equities provide good hedges against inflation currently? Maybe Kristina.
Yeah, let's give Kristina a chance.
Well, interestingly, if you go back and look at higher inflationary periods, counterintuitively, perhaps, technology does perform well. I mean, there are others that are more traditional, like materials, industrials tend to perform well. but actually technology does as well. Now, I would draw a distinction, as Anatole has, between speculative tech and what I think of as big, more, real profitable tech.
Yeah.
But I do think that we're seeing tech in general being painted, the big profitable tech being painted with the same brush to some extent as the speculative tech, especially when we see rates go up. I think that's a very short-term phenomenon, and I think investors could benefit from increased exposure to tech in this environment.
If I could just add, I completely agree with that. Technology, it's not a coherent sector because, and the key in an inflation environment is, does the company have pricing power, monopoly position, deep moat, and demonstrated pricing power, not just fantasy in the future. And obviously, companies like Microsoft, Apple, Google have incredible pricing power. So I think I agree, they do well in an inflation environment. But then you have these other businesses that have no demonstrated pricing power at all. Netflix, we saw a very good example, but does Tesla have any pricing power? I don't think so. It's about to operate. It is operating in one of the most intensely competitive industries in the world, but it's priced as if it already enjoys a global monopoly similar to the one enjoyed by Google or Microsoft.
Yes, you could have maybe made the same argument 2 years ago, and
Exactly. Yeah, you could, and it keeps going up. Yeah.
Yes. Okay. The last question from the chat, and I apologize to those people that have raised excellent questions and I haven't asked them. But Pim Zaalberg is asking essentially, what other policy measures other than monetary policy can and should be taken to control inflation?
Well, that's we could talk all day about it, and actually we'd possibly come to the conclusion that there aren't any, except for the one clear one is fiscal policy. I think has been shown to be as powerful, in fact, probably more powerful than monetary policy in managing demand as in the last 10 years. So as an alternative to tighter monetary policy, you could imagine much tighter fiscal policy, cuts in government spending, rising taxes. I think that's very, very unlikely. And again, to a certain extent, the war has also changed that. It's made expansionary fiscal policy more likely. Now, other things, deregulation. Well, and I suppose the other thing is freer trade, reducing. I mean, the US imposed a lot of inflation upon itself by starting a trade war with China and introducing tariffs against China. Yes, they could remove that, but unfortunately, I think the trend is in the opposite direction as well.
So I would agree that reducing tariffs would make sense, and there are certainly some fiscal policies. What would not work, though, are the wage and price controls utilized by the Nixon administration. Gerald Ford's public relations campaign, Whip Inflation Now, and a similar PR campaign from Jimmy Carter. Those are the things that definitely don't work.
Yep.
Okay. Sorry, I was distracted because my phone started ringing. I apologize for that. We're nearing 5 o'clock Amsterdam time, which is the end time for this webinar. We have 2 more poll questions, just to sum up and see what effect this discussion has had on the views of the participants. So if Irma can put up the first poll question. Oh, there it is. This discussion today has either made me more worried about inflation than I was, or B, made me less worried, or C, hasn't really changed my view on inflation. So A is more worried, B is less worried, and C, it hasn't had a material impact on my view on inflation. Now I have the advantage of being the moderator, and so maybe before this takes a while. There's one thing I have to say is I was a little bit surprised by the answers we got from both presenters on one of the statements I put to them, which was that bringing inflation down has to be given priority over trying to prevent a recession. in my humble opinion, and I don't mean to trigger a discussion now, but in my humble opinion, history shows that you cannot build a successful economy on high inflation, and ultimately high inflation undermines the economy, and therefore I think you have to give priority, even if it leads to recession. But that's just my opinion.
I agree with that. The only question is, do you do it this year or next year? But I agree.
Okay. All right.
Now, excuse me, Han, I've got to go onto another call, so I won't get to vote in the next poll. And maybe you could tell me what the result was.
I will do. Thank you very much,
Okay.
Anatole.
Thank you. And I could just say, there's anybody who wants to see the presentation in more detail, maybe the CFA can distribute that.
Okay. Thank you, Anatole.
Thank you,
Thank you very
Anatole.
much. Thank you.
Thank you very
Bye.
much. Irma, sorry, I saw the result of the poll question and then it disappeared from my screen. Can you see it or can you read it out?
Yes, Han. Let me see. A answer made me more worried than I was about inflation is 90%. Made me less worried than I was about inflation is 7%. Not changed my views on inflation is 19%. And since I downward the time of filling in the results, 45% was not able to answer the question. So the third poll question I will do a little bit longer again.
Okay. Oh, our participants are a bit slow. Is that what you're saying, Irma?
No, the first one was too long and now it's too short. So
okay. Anyway, there's more people who got more worried than who got less worried. And I suppose I can maybe I don't know. Interesting. Okay, the second and last and last question is more about portfolio positioning, and maybe you can put up. Oh, there it is. Our investment portfolios is adequately positioned to cope in case inflation continues to surprise on the upside. In other words, even regardless of what your views are on inflation, you can leave your portfolio as it is. So that would be answer A, agree. Or if you say, well, actually, listening to this webinar, I'm more worried, maybe we need to make some changes to prepare for higher inflation. That would be B. And C is you're not so sure. I don't think anybody can be particularly sure, by the way, but in our profession, we need to take views and be outspoken and try to look confident about it. I see Wim Zonnenberg is agreeing, but he's on mute, so we can't hear what he's saying. But yeah, okay. So agree that the position is adequately positioned. The portfolio adequately positioned is 22%, and those who want to make changes or think that changes need to be made 18%, and then 14 not so much. It's still only a turnout of 46%. I'm not sure if there was a technical problem, but it's pretty balanced. But slightly more people are happy with their current portfolio positioning. So that's quite interesting. Although complacency is a bad thing, people. Complacency is a bad thing. So maybe those 22% of you who think that you're well positioned, think again and be critical. Some critical self-reflection has never harmed anybody. And with that, I would like to thank Kristina. I'd like to hand over back to Annemarie.
Thanks, Han. I'm thinking, should I make some sort of joke about confidence of men versus women, and that there are more men in this group than women. So maybe complacency is more at risk than in other meetings, but I won't make that. Joke.
You've just made it.
Well, Kristina and Anatole already left. Kristina, very much for joining us. Really enjoyed your presentation. Han, I really enjoyed your lively moderation and excellent questions. And thanks so much everyone for asking the questions in the chat. Hopefully this is helpful, let's say, for your daily decision making, and yeah, it's definitely food for thought. Well, thank you all for joining us, and looking forward to seeing you all to one of our upcoming in-person events of some webinars we have scheduled. And I wish you all a very pleasant evening after this meeting. Bye bye.